But if you guys have questions on these types of assets, whether it's starting one, whether it's looking at the life insurance side, what's really cool about options for having Roths or life insurance is right now, if you're setting money aside, there might be a Roth option that you could pick very easily. If you make too much income to put money into a Roth, you can easily pick life insurance and be able to put the funds into life insurance that then gives you that tax-free income. Life insurance is interesting. Are you guys familiar that there's some policies that you buy for death benefit protection, and then there's others that you buy for the cash part? Right. So what we like to talk about is the cash value asset here, and why it's so unique, why it's really a great asset to put into your portfolio. You're able to do that without worrying about income limits, without worrying about contribution limits, and without worrying about when you can withdraw the money. Roths are the same. To me, having that tax-free income there, knowing that that would be something that grows tax-free, tax-deferred, that's going to be a great asset, and definitely something to include in your portfolio if you haven't already. I can take questions, I can be done, let you guys, is it networking next?
I noticed you mentioned the married filing jointly, but when I was coming up, earning all of those unnecessary amount of designations and letters after my name, we would say married filing separately are treated like lepers.
Yeah, they have probably the worst option a lot of times, unfortunately. Married filing separate, you lose a lot of different tax credits, a lot of deduction options. It's typically, I would say, definitely work with a tax advisor to make sure that that filing strategy works better for you, because most of the time, married filing joint is going to offer more opportunity for you.
And I know the way that people are able to get to the money in their life insurance policy is by borrowing.
Yes.
And a lot of consumers have a negative relationship with borrowing. Can you share any of your insight when it comes to what borrowing means?
You don't want me to get started on life insurance.
Maybe I do.
I am extremely passionate about life insurance and the fact that people aren't educated on how well it can work in a portfolio. I think if you can have it in your portfolio, everyone should, because it is an asset that you do have to make a commitment to it. You have to be able to say, I'm going to treat this like I would any other accumulation vehicle in my accounts. I want to make sure if I'm giving 10% of my salary to my 401k, let's say, maybe I look at the fact that my job, my employer matches 5%, let's say. If I'm doing 10, should I consider actually using that surplus 5 and maybe adding an asset like life insurance into my portfolio? Because when you mentioned the way that you distribute income from life insurance, you take withdrawals from Roth accounts, from 401k accounts. Those are just straight withdrawals, right? When you're able to take a loan out of life insurance, there's two options that you can take. One is a standard loan, where you just, when I borrow the money, I'm paying a 2% loan rate, and I'm being credited 2% from the policy that year. So that's a wash, right? Very conservative approach. If I'm a little more aggressive and I say, you know what, I believe in the market, I think the market's going to keep performing, I actually want to be able to earn money on my borrowed funds. You can do that with life insurance by picking an index loan option. And what that does is it says, you're going to maybe have a higher loan rate. Right now with Mutual's product, the loan rate is 5 and it's a max of 6. So that's important too. If you're getting life insurance, you want to make sure there's a cap on that loan rate. You don't want that to exceed and be something that's so high when you're ready to borrow that it doesn't make sense. But let's say I borrow at that 5% and then the market returns a 10. That's a pretty reasonable cap in the industry for cash value life insurance. I just made 5% on my borrowed money that I went and spent somewhere. It's still on the books. It's still part of my asset.
Arbitrage.
Now, what's that?
Arbitrage.
Yes, your arbitrage. So what is nice about that is I can potentially get more income from that asset in my portfolio than I would if I was just taking withdrawals. Now, it's not the only thing you should have in your portfolio, but it is a great addition to help diversify your accounts. The other cool thing about it, I put little asterisks next to the Roth, next to the life insurance, because you have special rules with those assets. With Roth, you have to be over 59 and a half to be able to take your money out. With life insurance, you don't. As long as you have cash surrender value in there, you're going to be able to use those funds whenever you want. People, we get some calls though, where people will say, I want to be my own bank. I'm like, okay, that's exactly what you can do with life insurance. You can be your own bank. And they'll say, okay, I want to start this policy and next year I want to borrow $200,000 from it. I'm like, what do you plan on contributing? Because if you're your own bank, you have to get the money in the bank before you can borrow it, right? So the only way life insurance is going to give you more right away than what you put in is if you pass away and your family gets your death benefit. So I want everybody to understand this isn't going to be something that you give us your premium of $10,000 one year and then the next year you borrow $200. It doesn't work like that. It's not that type of bank. But the cool part about it is you don't have a maturity term. When you take a loan from a life insurance policy, there is not a payback date. You could have that loan forever. When you pass away, your death benefit pays your loan back, and it gives your family the rest of the money. Okay? And so the illustrations, definitely go through those illustrations, talk through, hey, what would happen if I borrowed and at this age I passed away? That illustration shows you all that type of information because it's critical to understand loans, kind of in air quotes, that's a way to get funds out of the policy more than what you put in. It's allowing you all that interest that's been building up in your cash value account to come out tax-free. And then someday when you pass away, it gets paid off with your death benefit. Now, you could pay it off. You could say, I've had people who are in real estate, they like to purchase properties. So what they wanted to do was set up an asset like this so that they could borrow maybe $20,000, $30,000, and then after they sell the property, put back that money. You can definitely do that, but you don't have to. So the key to these is making sure you have a commitment to funding, you have the right structure, you always want the lowest face amount possible, and you want to shove as much money as you can into it. So the funds are always taking advantage of the growth opportunity there. If you don't have enough in the cash value account, let's say you're only paying the necessary costs of the policy, there's nothing to build. There's nothing to take advantage of the gain. So you really want to make sure it's structured the right way, and then you want to be with a good carrier. And I don't need to tell you which one I would pick there, but I have lots of reasons as to why we are a great company to work with. We keep our promises to our policyholders. For all of you out there that remember Mutual of Omaha's Wild Kingdom, you watched it with your family on Sunday nights, you know, that's the company. We're not a lot of bells and whistles, but we definitely are going to be there for people. So this can be a great addition. Like I said, I purchased policies for my kids. My goal there is I will fund these policies when my kids were dependents.